Welcome to Ben's Market Insights. In this week's episode, we're going to be talking about, in macro terms, what's happening with Iran and the reinstigation of the war. We're going to talk about the US CPI that comes out this week. Also, Kevin Walsh talks to Capitol Hill. We get UK GDP data, and on a micro level, we start to think about the financial sector reporting this week and the implications for market and for the sector. And in Europe, a very strong indication and guidance in terms of where the potential AI spend is going to come from when ASML reports on Wednesday. So let's kick off straight away with the Iran war. Looks like it's coming back to some extent. There are attacks by both sides on each other, but more of very specific, very low tone strikes, if you like. I think this is part and parcel of Iran's strategy to maintain a fairly low level of attack, if you like, against US assets in order to maintain and continue this clash for longer, knowing full well what's coming up in mid-November. That, from their perspective, is key because what it implies is that potentially there's more backbone, if you like, that will come to the Senate post the midterms in November. If that were to be the case, then the administration would be, if you like, sort of held in chains when it comes to strategy to implement the war aims against Iran. So Iran is playing the long game. I think from a market perspective, it has less of an impact than some pundits would expect, simply because the focus is all on AI and CapEx, and we'll come back to that in a moment. The next thing that I think is key is really around the issue of the US CPI, energy prices and rates. By the way, if you're enjoying this content, please subscribe to the channel, Ben's Market Chat, and give us a thumbs up and a like. Thank you very much indeed. So to continue, clearly the events over the last weekend and the last few days will lead to oil prices moving higher, and that's certainly happening in the pre-market at this moment in time. We are seeing also a steepening in the yield curve with the 10-year rates at 4.52%, and that again we'll come back to when we discuss financials. Clearly that it's implying a stronger US dollar, which we've been suggesting would be the case for a little while yet. And the CPI number that comes out tomorrow may be slightly low in terms of expectations at some 2.9%, but the Federal Reserve is still expecting a 2026 median number of 3.6%, which is pretty high. Now, I think the suggestion is to a large extent that the market believes interest rates are going to be moving higher this year by at least 25 basis points in the US by year end. I don't think that that's really on the cards just yet, but certainly that would be a contrarian view at this juncture. If it is the case that we don't see rate rises and maybe even a sneak lower, that is incredibly positive for markets. On a continuing the macro perspective, we've got the Bank of England coming through with their GDP numbers this week. There are many pundits inside the Bank of England that are suggesting that interest rates could be moving higher, depending on how strong those GDP numbers could be. Inflation is certainly under control at this juncture. There's no particular reason why interest rates should go up, but it doesn't sound like the Bank of England is being particularly dovish at this juncture. Not good for consumers, I would suggest. We've also got UK house builders beginning the report this week in the form of Barratt Homes, and I suspect that the consumer demand for housing remains very nervous and cautious, particularly if there's a view that interest rates are going to move higher. Back to the element of the strong AI perspective, we have ASML reporting this week on Wednesday. The management has been forecasting a 36 to 40 billion euro revenue level. That's an 18% year-on-year rise. Clearly, ASML and the rest of the semiconductor industry has been on a tear. Is that going to continue? What's their guidance going to look like? In terms of demand, in terms of manufacturing, half of their revenue is now dedicated towards memory. It was more, significantly more than that last year towards logic. So clearly maintaining the industry momentum around memory. Let's see what they say, but markets are really positioned very optimistically for stocks like ASML, trading on some 45 times forward earnings at this point in time. Very expensive, but certainly in line with their US peers. I would also suggest that what we're really looking at is a real transition potential here between the semiconductor industry, as I mentioned last week, and the Mag 7, so a return in the form of investment back into Mag 7 because they have been largely the spenders of this AI capex spree. I suspect we're going to start to see more of that beginning to head back towards the performance, rather head back towards the Mag 7 and away from the semiconductors. But let's see what ASML has to say. All rests on that for this week. Back to US financials who are reporting this week. I think it's very interesting that what we have seen is that the yield curve has started to steepen. So the 2-year has been maintained at a relatively low level. The 10-year at some 4.2%. The 10-year is heading up, as I say, towards the higher end of the 4.5s. That's very good for net interest margins for the banks. Also, let's keep in mind that fees have been incredibly strong for US investment banks, given the IPOs of the SpaceX and most recently Hynix. And of course, we've still got ChatGPT and Anthropic to come through, maybe still this year. If that's the case, then we're going to be seeing a very strong financial sector momentum going forward. Now, in terms of putting all of that together, in terms of an asset allocation strategy and currencies, I still believe that there's nothing has changed our view that US assets remain where we want to be invested and overexposed. Within that, start moving towards the Mag 7 and to some extent take the top off the memory trade. Certainly the semiconductor ETF has continued to lose momentum, certainly to the end of last week. We also suggest that the financials exposure in the US should remain overweight, given the strong both NIM, net interest margin momentum, as well as fee momentum. And when it comes to Europe, there is still very little to make investments particularly attractive. There is very little that the ECB can do at this juncture in terms of movement on interest rates. If the UK does raise its interest rates, then we're probably going to see a stronger sterling versus the euro. But overall, we're probably more likely to see the strongest US dollar above both euro and sterling over the next 2 to 3 months. Gold, of course, suffers in that kind of environment as US dollar strengthens and expectations of interest rates remain high for the US. And we're certainly seeing that. And I can't see the gold momentum, negative momentum trend reverses anytime soon. We have seen a little bit of a bounce back in the crypto trade, but I think that's more hope rather than particular direction in that asset class. So overall, overweight US, no change in that perspective, overweight financials in the US, and a potential move towards increasing positions in the Mag 7 going forward at this stage. That's enough from me for this week. Hope you have a great week and speak to you soon.